The first error that you would encounter typically is historical growth rates used to forecast. Typically, when you build a model, last 5 years growth rates are available. You would want to kind of project next 5 years growth rates. A lot of the times, what you project in the future is basically emanating out of historical growth rates. So, if a company is growing at 20% over the last 4 years, you'd probably assume 20% in the next 5 years, or 20 going down to something like 12 in the next 5 years. Now, the problem with this assumption is that it does not take into account the underlying business conditions, right? If in a sense, if a company is doing well mathematically, then in the model it will always do well, and the one that is not doing well will never do well. So essentially, if a company is degrowing at, let's say, minus 10%, the same logic would get applied on that as well, and that will keep degrowing or probably reach towards zero or slightly better growth rates. Whereas something that is growing at a fast clip will continue to grow there. Uh, Companies doing well today, on average, will get a higher valuation if we do this. And companies not doing well will be penalized for their history, regardless of what has happened in the history on business conditions. It is important for us to pay attention on what the business conditions have been, because otherwise, otherwise this is a simple plain exercise where we just go about forecasting it without paying attention to what the underlying thesis of the company is, right? Eventually, it's not just mathematics that is coming in. It has to be built on what the company does, what the industry is, right? You have to understand the industry dynamics. How do you address this? Next year's growth rate has to come from industry condition assumptions. You do need to have an understanding of the industry before you go about touching the valuation of a company, as well as company market share assumptions, right? It can only be arrived at by having a proper understanding of industry dynamics. Let's take an example and try and understand this. So this is what Maruti has done over the last many years in terms of their revenue from operations. This is Maruti Suzuki FY 11, 12, 13, 14, 15. Now, if you use historical growth rates, which is like minus 4%, plus 25%, minus 1% approximately, and plus 13% in 4 of the years, it's going to be extremely difficult. You take an average of these, it'll be all over the place. And that's purely because business conditions have changed dramatically across the period. There have been instances where the company has made dramatic changes to what they've done. For example, in this particular year, Maruti did not have any significant diesel variants, so they saw a dip in the sales. Next year, they introduced diesel variants, and this is the period where petrol and diesel prices went dramatically out of sync, and Maruti saw a dramatic jump in sales, right? And then it has again kind of stagnated, and it's continued to maintain its market share. Unless you have a sense of what kind of market share the company has, it's going to be futile to generally go and put in growth numbers here. You have to have a sense on what the industry data is and what kind of growth rates the industry would kind of have in the future, at least an assumption of that based on whatever data you have. And you have to kind of back calculate and check whether your assumptions are in line based on, passenger vehicle penetration per 1000 population in India today is about 15 cars. What is the level to which it could go to, right? So you project the population, you project the industry growth rate, and then you try and understand that this number goes to about 22. This number in China is about 40, right? So effectively, you're not way off the target, but it does give you a sense on how many cars can India sell, right? And then you go about making an assumption for the company where you assume the market share that the company will have, or you back calculate and derive a market share and say, will they be able to handle the 45% kind of market share all through? Historically, they have. In fact, they've increased it this year. They're about 46, 47, 48% in this particular financial year. And the dip in market share only occurred when they did not have real big flow of diesel variants. Now, unless we understand this dynamic about the industry, it's going to be a futile exercise trying to generally go about projecting the growth rate in sales or the growth rate in costs, right? That's the first issue that valuation modeling brings in.